Hey everybody, Mike here again. In the last video, we talked about how option sellers sometimes win across several different market conditions. So now I want to show you one of the cleanest examples of that idea, the iron condor. At its core, the iron condor is a defined structure option strategy built around a specific range of prices. In plain English, we're not trying to catch a big move either up or down. We're trying to make a trade that is going to be range bound given your certain time frame. So in the SPX, we're looking for different levels between the top and the bottom. You want that price range to fall in between the two prices that we're setting in that iron condor. So in this video, I'm going to break down exactly what an iron condor is, how the structure works, where the profit comes from, and some of the risks that are going to be involved with it. And really, this strategy is a really good strategy, but you do always have to respect the risks. So sit back, relax, and enjoy the show.
Just a quick reminder before we begin, this video is for educational and informational purposes only. This is not financial advice. Anytime you're dealing with investing or options, make sure you do your own research and make your own decisions. So, what the heck is an iron condor? I remember I first started trading, and I was talking with my wife, and I was kind of following a channel, some people that were trading. I barely knew what a call and put were, let alone, iron condors and butterflies and all this stuff and putting on all these legs. But once you get used to it, it's actually a pretty simple idea. So an iron condor is basically a four-legged defined risk option strategy. And it's built to profit if the SPX stays inside of a range, or any company that you're trading with. So you create that by selling a put spread on one side, and then you sell a call spread on the other side. Two different trades, four legs. So you're collecting premium from both directions. That's why it's generally considered a non-directional strategy. You're betting aggressively, or you're not betting aggressively rather, on the stock going up or down. You're betting on a more like a containment type of trade in a range, and seeing that you can only possibly lose on one side or the other, you're collecting double premium for putting on this trade, where usually you collect premium on a call credit spread or a put credit spread. In this case, you're collecting premium on both, but you want that price action to be in the middle of that range. So here's the four-legged structure. On one side, you're going to sell a put, and then you're going to buy a further out put for protection. That creates the put credit spread. I usually do these with like a 20 delta or so. On the upside, you sell a call, and then you buy a call further out, equal distance from the strike price that you're choosing. That creates the call credit spread. You put them together, and now you have an iron condor. The short strikes create the profitable range. The long strikes on either side of the shorts define your risk. You can only lose what the difference of the width of those strikes minus your premium collected. So the iron condor is really two credit spreads combined into one structure. That's the simplest way to understand it. So this is the part that matters most. The trade works best when the SPX stays between those two strikes. The middle area is your profit zone. If the price stays there, time decay is going to work in your favor, and the position can lose value in your favor. Literally, you want this to end up being worthless at the end. So this is why sideways action is ideal. Small moves can still work too. If the price goes up a little or comes down a little bit, you just don't want it to break the range. So once the price pushes beyond the break-even area, that's where the danger starts to increase. So in this is not a strategy for wild directional markets. It's a strategy for controlled range-bound conditions. Now let's talk about max profit versus max loss. So the max profit on an iron condor is the net credit that you received when you put on the trade. That part's simple. The max loss is the spread width minus the credit received. So yes, the risk is defined, but the risk doesn't mean it's a small risk. That's an important distinction. Iron condors are attractive because they can win a lot if in the right environment, but the reward is limited, and the risk still has to be respected. That's why position size matters so much. So why do traders use iron condors? First, they can produce range-bound income. Second, the time decay can help, especially when the price is behaving. Third, the risk is defined upfront. And fourth, the structure is very flexible. You can adjust strikes, widths, timing, depending on your setup. So there's a lot to like here. But all of that only matters if the market condition stays within the strategy. A good strategy in the wrong market can still be a bad trade. So here's where iron condors go wrong. They go wrong when traders confuse the high probability with safety. The big breakout move can hurt the trade quickly. So volatility expansion can make the position harder to manage. Oversized position sizing can turn a normal loss into a damaging one. And holding it too long can let a manageable trade become a problem. So the danger is not really the concept. The danger is poor risk management. That's the part that you have to understand as a trader. So before entering an iron condor, I want the setup to fit the market. I want the market to be calm, or at least like a reasonable range bound. I want support and resistance levels to be very visible. I want the credit collected to actually be worth the risk. I want the total risk to be acceptable before entry. And I want the position size to be small enough to manage. That's the key. The strategy should fit the market, not the other way around. The exit should be planned before the trade is even entered. That includes like a profit target, it includes maximum loss threshold, it includes knowing when the trade thesis is broken. It also includes avoiding the mistakes of letting small problem become a large loss. So this is one of those biggest differences between a casual trader and a serious trader. The edge is not the entry, it's the process. So here's my main takeaway. The iron condor is a range trade, not a prediction trade. You're selling the range, you're defining the risk, and you're respecting the exits. This strategy works best in calm range-bound conditions. It works worst when the wild directional conditions are there. So that doesn't mean that it's a bad trade. It just means that the strategy needs a home. And that part of becoming a better trader is learning where each strategy belongs. So I use the iron condor quite often in these exact scenarios. And I oftentimes don't hold till expiration, especially if it's a 0 DTE iron condor. I'm looking for anywhere between a 25% and a 75% profit, and then I'm out of the trade. It's just what I do. So, these are some of the management strategies I use, but always keep in mind you got to make a plan and stick to your plan every time. If you can do that and be disciplined, you can honestly make money in the market, especially by selling risk-defined option strategies. This is one of my favorites. So if this helped, please subscribe to Practical Income Investing. Like the video, share it, comment. We're building the SPX Income Strategy Lab, one strategy at a time. Learn the strategy, repeat the risk, build the process. Thanks for watching.